My name is Brad Stumpy. I'm a partner and the practice leader for financial institution compliance and loan review services at Anders. I'll be joined today by Sadie Carrera, Sandra Lane, and Jessica Likey, all of whom are former bankers, specialize in loan compliance, and have many years of experience in the industry. Before we get too far into this, I do want to point out that we don't have the handouts in the chat like we normally do. We ran into a little technical issue there, but they should shortly be coming through cyberspace on the way to you, your email. So if you keep an eye on your inbox within the next couple of minutes, hopefully you will see them there. If they don't make it through, then they will be included in the post-webinar materials that will come out within a few days. So HMDA is always among the most requested webinar topics. And since HMDA season is right around the corner, we thought now would be a great time for a refresher. Add to that, following our last 1071 webinar, we had questions from non-HMDA reporters about what they need to know about HMDA so that they can accurately report 1071 data. Well, if that is you, we've packed what you need to know towards the beginning of the session, so you're free to drop off once we get to the data fields. We did have nearly 400 registrants today, so wow, thank you all very much for that. But that also means that you're all muted, and unfortunately, we won't be able to unmute to ask questions. But Sandy and Jess will be in the Q&A, so please submit your questions through the Q&A feature and not through the chat. Before we do get started, also, I want to give everyone a heads up that things might go for a bit more than an hour like it was scheduled for. We tried to pare the information down, but we just couldn't quite get it to an hour. If you do need to drop off, don't worry about missing anything. We'll send a link to the recording out within the next few days so you can pick up wherever you needed to drop off. So let's go ahead and get started. If we could share the slides, please. So are the slides being shared? They're not showing up on my screen.
Yep, the slides are being shared.
Okay. All right. Just my screen then. All right. Well, let's start off then with today's highlights. We'll begin with a few definitions, and then we'll discuss what is HMDA reportable versus what is not HMDA reportable. For those of you who are not HMDA reporters and are just here to help with your 1071 reporting, this is the section for you. We'll then get into each of the data fields, discussing highlights of each and drilling down a little deeper into those where we commonly see errors. Finally, we'll wrap things up with how to submit your data and then also the resubmission thresholds. So definitions. If you've spent any time at all in compliance, you know that the foundation of a regulation is the defined terms. You have to know what it is they're talking about. We won't go through all the definitions in the regulation. That could take an hour all by itself, but we will start with a few that are critical to reporting. Probably the single most important definition in Regulation C is dwelling, which is one of those terms that each regulation defines a bit differently. Regulation C defines a dwelling as a residential structure, surprise, surprise, but it doesn't matter if that structure is attached to real property. Under HMDA, a dwelling includes, but it's not limited to, a detached home, an individual condominium or cooperative unit, a manufactured home or other factory-built home, or even a multifamily residential structure or community. So let's focus on that last word first, a multifamily residential community. The commentary to Reg C states that a loan related to a manufactured home community is secured by a dwelling for purposes of HMDA reporting, even if it's not secured by any individual manufactured homes. It's only secured by the land constituting that community and then also including the sites for the manufactured homes. We do run into this from time to time with clients who operate in rural areas. Also, from time to time, we receive questions about properties with residential, service, and medical components. And the commentary addresses these scenarios in that a property used for both long-term housing and to provide related services. So think assisted living for seniors, supported housing for persons with disabilities. Those are dwellings. However, transitory residences that are used to provide these services are not dwellings under HMDA, and properties that are used to provide medical care, such as skilled nursing, rehabilitation, or long-term medical care, also are not dwellings under HMDA. The final issue I want to touch on with the definition of a dwelling is mixed-use properties. This might be where you have a storefront on the street level and apartments upstairs, and it goes back to primary purpose, which can be determined using any reasonable standard. Generally, we see square footage or revenue generated, and the standard may vary on a case-by-case basis. So this is one part of HMDA where you don't have to be consistent, just be reasonable. So this slide includes 4 definitions that will be important to know, not only when it comes to whether you should report an application, but also when it comes to reporting the purpose of an application. First up is home purchase. This can be either a closed-end loan, which is more common, or an open-end loan, but focus on the phrase in bold type, in whole or in part. If any of the proceeds are to purchase a dwelling, even if it's less than half of the proceeds, then it's a home purchase loan. Home purchase loans can involve multiple properties. If I pledge my home in St. Louis to purchase a vacation home in the mountains, peaceful, that is still a home purchase loan, even though it's not secured by the dwelling being purchased. Home purchase loans also include both a combined construction permanent loan and the permanent financing that replaces a construction only loan. Home purchase loans include second mortgages that finance the down payment of first mortgages. And finally, home purchase loans include assumptions if the lender accepts the new borrower as the obligor on the existing loan to finance the new borrower's purchase of that dwelling via a written agreement. So next up is refinancings. Here we have the familiar satisfy and replace language. So actions such as extensions and modifications do not count as a refinancing. The new obligation must satisfy and replace the existing obligation. We'll see loans on a LAR that are used to pay down but not pay off a line of credit, and that's a mistake since it did not satisfy and replace an existing obligation. And the other important thing to note is the final phrase, by the same borrower. You must have at least one common borrower on the existing loan and the new loan. It could be John and Joe Smith on the old loan and only Joe Smith on the new loan. That would count as a refinance since there's a common borrower. However, if the second loan is in the name of Smith Brother Properties LLC, with both John and Joe signing as members of the LLC, that would not count as a refinance since the entity is the borrower on the new loan. So that last scenario would be a purchase if ownership of the property was being transferred from the individuals to the entity via that transaction. The third definition on this page is a subset of refinancing. So first of all, it must meet the definition of a refinance. Second, there must be some difference in how that application is processed or how the terms are set based on the fact that there's cash out. And we see these most commonly with secondary market transactions. When we see a portfolio loan reported as a cash out refinance, we'll ask, how are portfolio cash outs processed or priced differently than a non-cash out refinance? And more often than not, we're told that there is no difference. And when there is no difference, then under HMDA, it should not be reported as a cash out refi. That designation is there so that someone analyzing your LAR can compare apples to apples. they'll know that this set of refinances was processed or priced differently than others. So finally, home improvement loans. We again have the in whole or in part language, along with the obvious repairing, rehabilitating, remodeling, or improving a dwelling. And then we get to the part that trips some folks up, or the real property on which the dwelling is attached. So if my wife talks me into rehabbing our pool, and Lord knows we'll need a loan for that, that's a home improvement loan, just like landscaping or adding a garage would be. Another issue that comes up on the home improvement front from time to time are the mixed use properties that we discussed under the definition of a dwelling. If improvements are being made to a mixed use property and the proceeds are not being used to improve the entire property, then you'll need to determine if the improvements are primarily benefiting the residential portion of the structure. If you have to do this, be sure it's reasonable, and by that I mean, can you reasonably convince your examiners or auditors of that fact? You'll put yourself in their shoes. And as always, be sure it's well documented. All right, full reporter versus partially exempt reporter. So those of you who have been in the HMDA game for more than a handful of years know that the reporting thresholds for both closed and open-end loans were a moving target for a while. The dust has settled on those thresholds, and no, I have not heard of any proposed changes to those thresholds under the new administration, though a few of you smaller reporters on the line have already asked me about that. Then for the past few years, there have also been different levels of reporting requirements. Smaller reporters can report fewer data fields, and we refer to this as the partial exemption. The next few slides will cover both the closed and open-end reporting thresholds, as well as the partial exemption threshold. So first, who must report? Whether or not you are able to take advantage of the partial exemption, and this is kind of a continuation of the definitions from the previous section, defining a financial institution under Reg C. The location test applies to all reporters and requires to have you a home or branch office in a metropolitan statistical area. The asset size test only applies if you're a depository, so a bank, credit union, or savings association, which I believe covers just about everyone who registered for the webinar. The asset threshold, which is adjusted annually, currently stands at $56 million. The final test has to do with the volume of originations, and there are separate and independent thresholds for closed-end originations, which is 25, and open-end originations, which is 200. You'll note that these thresholds are based on originations, not applications. While you will report denials, withdrawals, and so on, these thresholds look strictly at originations and must be met for each of the prior 2 calendar years. So you can be a closed-end reporter and not an open-end reporter, which is common for smaller institutions. You can be an open-end reporter and not a closed-end reporter, which is not that common of a scenario, or you can be both a closed and an open-end reporter. All right, before we get into who qualifies for the partial exemption, let's have our first poll to get a feel for everyone's familiarity with this concept. We'll continue our tradition of selecting winners for Starbucks gift cards from those who participate in the polls. So if you're craving your favorite holiday flavor, maybe a peppermint mocha, maybe a chestnut praline latte, be sure to participate. All right, so choose which option best describes your scenario. Are you a full reporter for both closed and open end? Are you a partial reporter for closed end and fully exempt from open end? Are you a partial reporter for both? Are you some other combination? There's plenty of other combinations. We didn't have room to put them all here. Or are you fully confused and you're not really sure? So we've got some responses coming in, and it looks like the majority are full reporters for both closed and open end. And then in second place will be partial reporters for closed end and fully exempt from open end. If you want a chance at that gift card, respond soon before we close that poll. But thanks to everyone for participating in that. All right. So on to partial exemptions then. The first thing to keep in mind is that the partial exemption is only available to insured financial institutions, a member FDIC, member NCUA. So if there are any of you out there who don't fall into this category, unfortunately, you're not eligible for the partial exemption and you're a full reporter regardless of your level of originations. For those of you who are insured financial institutions, you can take advantage of the partial exemption for closed-end and or open-end loans if you originated fewer than 500 of either during each of the last 2 calendar years. So if you originated from 25 to 499 closed-end loans in each of the last 2 calendar years, then you can take advantage of the partial exemption for closed-end loans. And if you originated from 200 to 499 open-end loans in each of the last 2 calendar years, then you can take advantage of the partial exemption for open-end loans. So you could be a full reporter for closed-end and a partial reporter for open-end, or vice versa. Many of our clients with smaller LARs are partial reporters for closed-end loans and do not report open-end loans at all. So finally, if you're an insured depository bank, so if your advertisements have to say member FDIC, then you cannot take advantage of the partial exemption if you received a needs to improve at each of the last 2 CRA exams or substantial noncompliance at your most recent CRA exam. So one more reason to keep those CRA ratings boosted. So if you are eligible for a partial exemption, be on the lookout for asterisks as we go through the different data fields. We've marked the fields that you do not have to report with an asterisk. So no asterisk means everyone reports, and an asterisk means that only full reporters must collect and report those fields. And we'll remind you about that again later. Okay, reportable and non-reportable applications. This is the last section before we get into the nitty-gritty of the data fields. For those of you who are 1071 reporters but are less familiar with HMDA, this is the section for you to perk up and pay attention. If you have an application for a commercial loan that would otherwise be reportable on your small business register, but it's also reportable under HMDA, it should be reported on the HMDA LAR and not on the 1071 register. HMDA reporting takes precedence over 1071 reporting. So let's start off with a few general comments about the types of applications that must be included in the LAR. As you look through these 3 bullet points, you'll notice a common theme. The application must be for a loan that is dwelling secured. No dwelling equals no HMDA. The vast majority of home purchase and refinance loans will be secured by a dwelling, but if you do come across that odd duck that is not, then it's not HMDA reportable, so could be 1071 reportable if it meets the 1071 criteria. The one loan type that we run into more often that meets the purpose test, but not the dwelling secured standard, is home improvement loans. It's not that uncommon to come across a home improvement loan that is not secured by a dwelling. But even for applications for home improvement loans, the same rule applies. No dwelling equals no HMDA. The next trend you may notice is the repeated reference to home purchase, refinance, and improvement loans. So for those, refer back to the definitions that we covered earlier. For business purpose applications, notice that if it does not meet one of these 3 definitions, then it is not HMDA reportable, so might be 1071 reportable. For consumer purpose applications, notice that there's an other category. So if you have a dwelling secured consumer purpose loan that does not meet one of the purchase, refinance, or improvement definitions, it could still be HMDA reportable if it's not a loan type that should be excluded, which coincidentally enough, we get to on the next slide. So here we get into the types of credit that should be excluded from the LAR. First are those to be secured by unimproved land. The exception here besides the one regarding manufactured home communities that we discussed earlier, is that if the loan proceeds will be used to construct or purchase a dwelling that will be placed on the land within 2 years of closing, then it would be reportable. And we rarely see this exception used because the temporary financing rule takes precedence over this unimproved land exception. The commentary to Reg C says a loan is temporary and excluded if it is designed to be replaced by separate, permanent financing by any financial institution to the same borrower at a later time. So this is going to knock out pretty much all of your construction-only loans from HMDA reporting. We do receive questions from time to time about how to apply the temporary financing exclusion to various types of commercial loans. One is the flip, where an investor gets a short-term loan to purchase, rehab, and then resell the loan. Since the borrowing investor is not expected to later obtain permanent financing, these should be reported. Conversely, the official interpretations specifically say that a construction-only loan extended exclusively to construct a dwelling for sale is considered temporary and is not reported. Then the third bullet point, if the application is for a loan that is primarily for ag purposes, or if the dwelling is on real property that is used primarily for ag purposes, so a farm, then it's not a HMDA reportable application, so maybe 1071 reportable. Reg C refers back to Reg Z, truth in lending, to see what is ag purpose. So you can always look that and do a little research. There are additional exemptions not listed on this slide, but we rarely see them come into play. Maybe with the exception of the purchase of a partial interest in a loan, so you don't report partial participations purchased. Otherwise, the ones listed here are the ones that we commonly see problems with. Next up are loans involving multiple institutions. Essentially, if your institution makes a credit decision, then the application should go on your LAR. It doesn't matter if the applicant submitted the application directly to your institution, if the loan closed in your name, if you funded the loan, all that matters is who made the credit decision. A common scenario here is that your institution does not have underwriting authority for a loan that you will sell in the secondary market. So you forward that application to an investor who will purchase the loan after origination. Since the investor made the credit decision, they will report the loan as an origination on their LAR, even if it closed in your institution's name and your institution funded the loan. If you take a quick look at the application and it is so bad that you deny it without sending it to the investor, that you'll report the denial on your LAR. You made the credit decision and they didn't even know that application was submitted. Similarly, if the application was withdrawn before you submit it to the investor, they again don't know that that application ever occurred. It goes on your LAR as a withdrawal. On the other hand, if it's withdrawn after you submit the application to the investor, then it belongs on their LAR and not on yours. If your institution does have underwriting authority and makes the credit decision based on the investor's criteria, you've made the credit decision and that application goes on your LAR. All right, so what is the interplay between HMDA and 1071? If the application is HMDA reportable, then it should not be reported on your 1071 register. And that holds true whether or not you're a HMDA reporter. So yes, HMDA equals no 1071. And it will become very important to make this distinction as early as possible during the application process. A big reason for this is that there are different sets of information that you'll have to collect depending on whether you have a HMDA or a 1071 application. For 1071, you need number of employees, time in business, number of principal owners, and all kinds of information that you don't need if you have a HMDA application. Additionally, the form you use to collect demographic information, such as ethnicity, race, and sex, is different for HMDA versus 1071, It has different disclosures. You're asking for information on possibly 4 individuals for 1071 rather than 2 for HMDA. For 1071, you don't complete the form based on visual observation or surname at all, while for HMDA, you may need to. For 1071, the form includes additional requests for ownership status, women, minority, or LGBTQI plus owned. And then finally, you have firewall considerations under 1071 that you do not have under HMDA. So essentially, with a commercial app, you're at a 3-pronged fork in the road. One road is the HMDA highway, and I think maybe AC/DC sang a song about that highway going somewhere once upon a time. Another is the 1071 traffic way, which is always backed up. And the third is the neither one of them freeway. You don't want to go down the wrong road and have to make a U-turn. So in short, the sooner you can determine what type of application you have in front of you, the easier it's going to be to correctly process that application. Okay, then this slide includes the mandatory data collection and reporting dates for the different 1071 tiers. So if you're tier 1, you only have about 7 months until data collection, and tier 2, just a little over a year. Remember that 1071 allows you to begin collecting data up to 12 months in advance, so you can begin testing your systems. You might not need that full 12 months, but I'd encourage you to do some type of dry run before your mandatory compliance dates. So if you only joined us to get a feel for what types of applications are HMDA reportable to help with 1071 reporting, this might be a good place to drop off, as we'll primarily be discussing the HMDA data fields from here on out. You're welcome to stay on, but if you do decide to drop off, thanks for joining us, and we'd love to see you back at our future webinars. So now we get into the nitty-gritty of all the different data fields. And remember that if you're eligible for a partial exemption, the fields that you are not required to collect a report for have an asterisk next to them. So I'll start off with the first few data points, and then I'll turn it over to Sadie to finish them off. So you're almost done with me. So first up is the Universal Loan Identifier, or ULI, which includes your legal entity identifier, LEI, followed by a unique identifier for that particular application, and then ending with a check digit, a couple check digits. As the name implies, the identifier should be unique. You can't use it again on the current or any future LAR, never again in the future. It should not include any personal information, such as the applicant's name, date of birth, social, and so on. If you sell the loan, the purchaser will report that purchase on their LAR using your ULI. And if you purchase a loan from another HMDA reporter, you'll include it on your LAR with their ULI. So that loan can be traced back to the originating institution no matter how many times it's sold. You'll notice this field has an asterisk, so that means that a ULI is not required for those who can avail themselves of the partial exemption. But this asterisk should probably also have an asterisk. Partially exempt reporters do not need to assign a ULI that includes the LEI or check digits, but must have a unique identifier that does not include personally identifiable information and is not repeated on that year's LAR. So just within that 1 year, you can't report the identifier as a partially exempt institution. The only issue we really come across with any irregularity for this field is duplicate identifiers. So be sure you're checking your edits for those. Next up is the application date. Here you have some options, but the rule does call for consistency, at least within a particular department or for a particular category of loans. Most use the date received, if not for convenience, then to make fair lending analyses more accurate. We've heard stories recently of examiners basing fair lending analyses on how long it takes to process applications for a target group versus a control group. One issue we run into with application dates is multiple applications in the file. Be sure to use the earliest one or document why a later date makes more sense. And that might be, switching from a pre-qual request to a full-blown application with a property address. For brokered applications, there are three options: the date the third party received the application, the date the reporter received the application, or third, the date shown on the application itself. Reinstated applications, these are apps for which within the same calendar year, an applicant requests that an application that was previously denied, withdrawn, or closed for incompleteness be reinstated. In these instances, you can choose to either use the same ULI, in which case you report the earlier application date, or a new ULI, in which case you report the date of the request for reinstatement as the app date. The only time you should report the application date as NA is when you purchase a reportable loan from another lender. All right, last bullet here, commercial loans. We often encounter reporters that have difficulty in determining the application date for commercial loans, since most lenders don't require a standard application for these. We're starting to see that change as 1071 gets closer. We'll see just how far it goes, but we will find appraisal orders, title commitments, flood letters, significant correspondence with the applicant, all that predate the reported application date. Be sure you have a system in place to capture the app date, and then document anything preceding the reported date with an explanation as to why you didn't have an application at that point. Loan type. Most of the time, this one's pretty easy. For applications that do not result in an origination, report the loan type for which the applicant applied. There should not be any NAs in this field. Next up is the loan purpose, and we covered a lot of this in the definition, so I won't go over all of that again, but everything we discussed under the definitions applies here as well. For purchases, the most common issue we see is not reporting a separate permanent loan that replaces a temporary loan as a purchase, so usually with those construction loans. For home improvements, the most common mistake is not reporting a loan that improves the real property on which the dwelling is located. So remember, we talked about my pool there. Refis and cash out refis, so codes 31 and 32. Similar to what we discussed in the definition section, the most common error we see here is an application reported as a cash out refi, so code 32, simply because there was cash out. And that makes sense, common sense, but if the processing of the application or pricing of the loan was not impacted by the fact that there was cash out, then it should be 31 and not 32. The fifth code here, code 4, is for other. This is a catch-all for everything else. An example given is for educational expenses. This is where all of those consumer purpose loans that don't meet the definition of a purchase, refinance, or home improvement will fall. There should not be any commercial loans with code 4. Commercial loans should all be under purchase, refi, or improvement. So in the event that you have an application for a multiple purpose loan, there's a hierarchy to follow. And that hierarchy has nothing to do with the percentage of proceeds allocated to each purpose. And it probably causes the most errors we see in this field. So home purchase is perched at the top of the hierarchy. So if any of the funds are for home purchase, then you report code 1. Next comes refinance, followed by home improvement, with other at the bottom of the pecking order. So if you have a refinance with additional funds for improvements, you would report that as a code 31 or 32, even if a greater percent of the proceeds went towards the improvements. Here we have requests for pre-approval. It's not uncommon for us to review a decent sized LAR, and this field will be reported as code 2 all the way through, pre-approval not requested, every line on the LAR. And almost always, that's perfectly fine. The only time you could possibly have a code 1 is for a closed-end application to purchase a 1 to 4 family dwelling. Any other scenario, your only option is code 2. It doesn't matter what you call a program. You can call it a pre-qual, a pre-approval, whatever else. To have a pre-approval program under HMDA, you must regularly respond to these requests with a comprehensive analysis of the applicant's creditworthiness, and that includes verifications. You also have to issue a written commitment that's valid for a designated period of time and up to a specified amount. And then finally, you must not subject the commitment to limitations other than the identification of a suitable property, no material change in the applicant's financial condition or creditworthiness, or those conditions that are ordinarily attached to home mortgage applications. So think here, a clear title, pest inspection, maybe getting a closing disclosure from the sale of the current home. I think you get the picture on that. So if you only respond to these requests on an ad hoc basis, then those do not need to be treated as a pre-approval request under HMDA. You can make life easy on yourself and just report code 2 across the board. Okay, construction method. Here you have two choices, site-built or manufactured home. Report code 2 if the structure satisfies the definition of a manufactured home under HUD's regulations. The easiest way to do this is to see if the structure has a HUD certification label and data plate. Most appraisals include a photo of the data plate if there is one. Also report code 2 if the property is a manufactured housing community. Then report code 1 for everything else, including modular or factory-built homes and also multifamily dwellings. All right, occupancy type. What we're looking for here is whether the property will be occupied by the applicant or the borrower as a primary residence. So a common error we see here is that occupancy status is reported based on whether the property is owner occupied. So most of the time, the applicant is the owner, but not always. So be sure you're making that distinction. Use code 1 if the dwelling will be occupied by the applicant as a primary residence, keeping in mind that someone can have only one principal residence at a time. For HMDA purposes, if the borrower intends to use the subject property as a principal residence within 1 year or upon completion of construction, then the new dwelling is the principal residence. Also use code 1 for loans you purchase from someone else, unless the loan documents or application indicate that the property will not be occupied as a principal residence. Use code 2 if the property will be occupied by the borrower for a portion of the year, but it's not the primary residence. And if the property is occupied by the borrower for a portion of the year and then rented out for the remainder of the year, you'll think of the earlier example of my vacation home in the mountains, I wish. Use code 2. And then report code 3, investment property, if the property is not occupied by the borrower. And that's whether the plan is to generate income by either renting or by selling the property. Okay, in the loan amount, we have a relatively easy field. You should report the entire amount, including cents at your option. For open-end credit, be sure to report the entire amount of credit available under the line, not just the initial draw or the amount allocated to the reported purpose. For applications not resulting in origination, report the amount originally applied for, and that includes unaccepted counteroffers. If I apply for a $150,000 loan, but the appraisal comes in too low, so you call me up and say, sorry, Brad, your house didn't appraise out like we hoped, so we can't lend you $150,000, but we're happy to offer you $125,000. If I say no thanks, then you report that as a denial of a request for $150,000, not a withdrawal or an approved not accepted for $125,000. That's probably one of the more common errors we see for both loan amount and action taken. If I say, great, let's do it, then you report that as a $125,000 origination. The small entity compliance guide includes a page-long table that details what amount to report under various scenarios. You can always reference that if you have questions. All right, so here we have our second poll. And it has to do with our next slide on action taken. It also provides you with another chance at that gingerbread cream cold foam, or maybe you prefer a snowman cake pop. So here you've approved an application subject to a satisfactory appraisal, and then the applicant decides she doesn't want to pay for an appraisal and doesn't want the loan. Should this be reported as an origination, approved not accepted, denial, or withdrawal? So select which code you think should be reported in this instance for your chance at a Starbucks gift card. And code 4 was way in the lead. Now it's pretty tight between withdrawn or approved not accepted. And those are probably the two best choices. I would go with a withdrawn application in this case because all underwriting and creditworthiness conditions had not been met prior to express withdrawal, since the approval was conditioned on an acceptable appraisal. So code 4, withdrawal, would be the winner. If you had that satisfactory appraisal and then they withdrew, you'd be looking at an approved, not accepted application. So thank you everyone for participating in that. Well, on this slide and the next, we have the 8 possible choices for action taken. And this one is one of the more common fields that we see errors in. So code 1, originations, is pretty straightforward. While we don't see it often, remember that a rescinded loan must be reported as approved, not accepted. Then when we get into approved, not accepted applications and begin talking about conditional approvals, the rule introduces the concept of underwriting or creditworthiness conditions. And that's going to be conditions that constitute a counteroffer, like a higher down payment. It's also going to be things like a satisfactory DTI or appraisal, a need for PMI, the verification or confirmation of items such as income or assets, and the like. And it also introduces the concept of customary commitment or closing conditions. And these are going to be clear title, acceptable survey, acceptable title insurance binder, clear termite inspection, subordination agreement from another lien holder, and other things along those lines. So this takes us back to our poll question. Since a satisfactory appraisal is an underwriting condition, it doesn't meet the criteria for code number 2, approved not accepted, but rather meets the criteria for code number 4, withdrawal. You'll see that code number 3 for denials includes unaccepted counteroffer, which goes back to the example we used for the lower than expected appraised value on the loan amount slide. For code 4, withdrawn, the applicant must expressly withdraw the application before satisfying all underwriting or creditworthiness conditions and before you deny the application or close it for incompleteness. If they're simply not responsive and do not expressly withdraw the application, that's not a code 4. In fact, it doesn't fit any of these scenarios. You have to choose what step you want to take next, and we'll continue that conversation on the next slide. A common error we see is reporting code 5, closed for incompleteness, when the applicant is not responsive and we haven't sent any Reg B notices. Now, you have a couple of options here. You can send an adverse action notice for an incomplete application and report code 3, denial, or you can send a notice of incompleteness under Reg B that says, hey, Brad, here are the specific things we need from you, and here's when we need them by, or we'll consider your application closed. If you send that notice and I don't get the needed information to you by the due date, then you have a code 5. Report code 6 if you purchase loans from another lender, and code 7 and 8 only if you have a pre-approval program, so we don't see 7 and 8 too often. If you really want to dig into the details of the action date, there's a 4-page chart describing what dates should be reported for various types of action taken in the small entity compliance guide. And we've included some of those more common ones on this slide, and it presents you with some options. One thing to keep in mind is that while you do have some options, you'll want to be consistent within a certain department or for a certain loan type. For originations, you can report the disbursement date, but in the few instances we've seen this, it usually causes more problems than it solves. Also, for a construction to perm loan, you can use the date the loan converts to permanent financing, but that's one more tracking system to put in place, and is not something that we commonly see. Approved, not accepted. Examples given of a reasonable date include the approval date, the deadline for accepting the offer, or the date the file was closed. Denials. Here we've had a few clients try to use the date the decision was made to deny the loan, but as with the disbursement date, it's one more item to track. The method where we see the fewest errors is with the date on the adverse action notice. For withdrawals, most often we see an email from the applicant stating they're withdrawing. Use the date of the email, or a memo to file that the borrower called and withdrew. Just be sure to note the date that they called. All right, property address. Here's the final slide before I turn things over to Sadie. So you're almost done with me. Notice here that we do not have an asterisk at the top of the slide by property address, but rather we have asterisk the fields such as street address, city, and zip code that partially exempt reporters do not have to report. The purple bolded field, state, county, census tract, must be reported regardless of status. Note on the examples that there's no punctuation in the street address. The state is the 2-letter abbreviation rather than the state code. The zip is the 9-digit version. And then also notice the formatting for the county and census tract codes. For loans that involve multiple properties, you can essentially choose any property that secures the loan. Once you pick a property, follow it all the way through on the LAR and report codes such as occupancy and construction type that apply to that property. Think also about being strategic here, and if possible, select a property in your CRA assessment area, and then if possible in a lower moderate income census tract where you don't have much activity, or maybe to an LMI borrower. Don't shortchange yourself. Help yourself out every time you get a chance. And finally, you may report NA if the property did not have an address at closing, the location for a manufactured home has not been identified, or you did not have a property address before the application was denied, withdrawn, or closed for incompleteness. None of these are anything that we see commonly, so I would use them sparingly. And with that, let me give the reins to Sadie so she can cover the rest of the data fields, and then I'll be back at the end to wrap things up. Sadie, it's all yours.
Thank you, Brad. Good morning, everyone. I'm Sadie Carrera, a compliance manager with Anders CPAs and Advisors. And I'm going to continue with the data fields this morning, beginning with everyone's favorite demographic information, which we refer to as DI. Of course, here we're talking about ethnicity, race, and sex. Now, DI really has two components to it. You have your data integrity of the information that's reported on the LAR, and you have the accurate collection on the DI addendum, which we'll discuss on the next slide. We have both aggregated and disaggregated categories. Some examples of aggregated categories would be Hispanic and Latino, or Asian, and then potential subcategories, which are the disaggregated categories, such as Mexican or Cuban, Korean, or Japanese. Now, if the applicant does not feel that any of these categories fit, they can choose to mark the other box, then write in their ethnicity, race, and sex, and which we would report in the free-form text fields for that appropriate aggregated category. One thing we have to remember here is that we want to report exactly what the applicant furnishes. Very important. Now, we must also report whether we collected DI based on visual observation or surname, and those are for only those applications we take in a face-to-face interview. Now, this next slide shows the DI addendum form. It's super duper small. It's very hard to get that on the actual slide, but I have highlighted some fields for us to point out some of the most common mistakes we see. So if we have an application in a face-to-face interview, and only if it's taken in a face-to-face interview, we have an obligation to collect DI on the basis of visual observation or surname when the applicant states that they just do not want to furnish that information. Most common mistake we see is not marking on that form that I do not wish to furnish that box and the box for the DI observed. Another common error we see is not indicating how the application was taken. Not all forms say that we fill out that information in a face-to-face interview only. So we must know, it has to be known how we took that application in order to determine whether DI should have been collected based on the visual observation or surname. The next slide, we talk about age. Age, we're going to report the age of the application date. So whatever age they are at the time of the application that we're going to report of that date. Report for the applicant and first co-applicant. We do not report for a guarantor. And for purchase loans, you may report the age or you may not report the age. You can report NA, but we just need to be consistent. Income. When we're talking about income, we're going to report gross annual income that was or would have been relied on in making the credit decision. So not applicable, reporting not applicable is only acceptable for employees, if the applicant or co-applicant is a non-natural person. So Sadie Carrera is the applicant and Carrera Properties, an entity, is the co-applicant. Since one of the applicants was not a natural person, income would be reported as NA. We'd report NA for multifamily dwellings, purchase loans where the financial institution chooses not to report income. Again, be consistent. If income was not provided by the applicant in any form, so it's not on the application, we haven't collected that information at all, or for a loan type such as a streamlined refinance where income is not collected and has no impact on the credit decision. We'd include applicable income for a cosigner, but not for a guarantor. Income can be a negative number. And as the heading of the slide notes, this field includes an allowed tolerance for rounding errors to the nearest 1,000. So we'll move on to purchaser type. The next two slides contain all the available choices we have for purchaser type. Now here on this slide, you can see code 0, not applicable, which you'll use for loans not sold in the same calendar year that it was originated or purchased. Any non-originated application, including pre-approval requests, and participation loans in which some interest was sold, but the majority was retained. Of course, we have all of our other codes there. On our next slide, we have purchaser continued. So for those participation loans in which a majority of the assets were sold, you would report the code that best fits that entity, which purchased the greatest percentage of that asset. On this slide, we also have code 9. That kind of trips us up sometimes. This is going to be used if it did not fit into any other category. And our most common that we typically see reported as an other or code 9 is the Federal Home Loan Bank. Rate spread. Well, as we know that this can be one of our trickiest fields to report. And given the length of time we have today, I'm not going to be able to touch upon all the scenarios that could arise from this field. But with that said, I have some important items to note. Rate spread would be required to be reported for all loans and approved not accepted application and pre-approval requests that are subject to Reg Z other than purchased loans, reversed mortgages, and assumptions. If a corrected truth in lending disclosure has been disclosed, has been provided, then we're going to rely on that APR when we calculate that rate spread from the corrected disclosure. Now, for some open-end loans, you're supposed to identify to the most comparable closed-end loan. And when you're choosing the information in the FFIEC calculator, if you have a variable rate, let's say for an example, you have a variable rate HELOC and the rate changes daily, you would choose variable for your amortization type. And you would choose 1 as the years to first adjustment, since 1 is the least value available to enter in that field. If the term is not in whole years, we use the number of years closest to the actual term. And if it's exactly halfway, they want us to use the shorter term. Determining the date the rate was set has long been a point of concern for years now. The regulation is tempted to clear this up with some examples. They're not the best examples. They're not the easiest for everyone to follow, but here's some ways that can be done. If there's a rate lock agreement, we want to go with that rate lock date. If there's no agreement, then some common choices that we see and again, be consistent, would be to choose the time of the application. We would choose that if the rate does not change from application to closing. Also, we see the date of the last disclosed rate on an initial or reissued LE or CD, whichever one that reflects that final rate. Now, again, given we only have an hour and we're already almost done with that hour, all kinds of rate lock extension issues and change of program scenarios could arrive. But if you want some further detail and some further guidance, I would look to the official interpretation or the commentary to this field, which you can find at section 1003.4A12. HOEPA status is a pretty easy one here. We have 3 different choices. We're going to report code 1, high cost mortgage, or code 2, not a high cost mortgage, as applicable. Again, that is if the loan is subject to section 32 of Reg Z, which basically is a consumer purpose loan secured by the borrower's principal dwelling. We'll report code 3, not applicable, if the loan is not subject to section 32 of Reg Z. Essentially, it's not a consumer purpose loan secured by the primary residence, or if the application did not result in origination. Following that up is with lien status, and we only have 2 codes here. We basically are going to report code 1 if we are secured by a first lien, and code 2 if we're secured by a subordinate lien. Now, when we're taking care of the lien status and we're taking a look at that and going to report, we're going to use the information that's reasonably available to us at the time the final action is taken. Credit score and credit scoring model. We're going to report the credit score that's relied upon, as well as the name and version of the model that's used for that score. We would report NA for purchase loans, files closed for incompleteness, withdrawn loans, and any non-natural persons. If we obtained a credit score for both applicants, but only relied on score for one of the applicants, such as with secondary market loans that use the lowest middle score of either the co-applicant or applicant, we're going to report only the score that was relied upon. If only one score is relied on, you can either report that score and model for the applicant and then report the code for not applicable for the co-applicant, or vice versa. You can choose to report them all for the co-applicant and use the NA code for the applicant. Of course, again, we want to be consistent. There will be specific codes for the names and versions of the models used. We have additional codes for when more than one model is used, and a code for other when none of the other codes work in our favor here. Then we have a free form field that we could describe other, describe that other model for up to 100 characters. Now, as we will see in the future slides here with underwriting criteria such as DTI and CLTV, when the rule says to report the credit score that was relied on, it should be reported even if the credit score was not the dispositive factor. That is, if the score was one of multiple factors that we considered in the credit decision, then we want to report it. And lastly, for credit score and credit scoring model, if your institution averages scores, we're going to report the average score, and then you'll report that code, which is code 7, for the model that indicates that more than one scoring model was used. Moving on to reasons for denial. The next 2 slides will illustrate the codes that we have available to report for reasons for denial. We will report the applicable reason for denial code for an application in which the action taken was code 3, denial, or code 7, pre-approval request denied. Again, we don't see those very often. All other actions taken will report code 10, not applicable. We can report up to 4 reasons. If there was only one reason that was on your adverse action notice for denial, then we report that 1. If we had several reasons, we're going to report up to 4. And again, you can use that your adverse action notice to guide your reasons. On the reason for denial continued, we can see we also have a code 9 here for other, which will trigger the reporting of a free-form field that gives us up to 255 characters to specify the other reason. Now, an example of one of our biggest mistakes we see here with the reason for denial field would be reporting a code 9 other and then specifying something such as no down payment or insufficient down payment in the free-form field. However, there's actual code for that, which is insufficient cash, that which will include down payment and closing costs. Accordingly, code 5 should have been reported rather than code 9, and the free-form field should have been left blank. Again, we'll use code 10, not applicable for any transaction that was not denied. Total loan costs and points and fees. The next slide and the next 3 slides will contain a lot of data that's going to be pulled from your closing disclosure. This slide for total loan costs and total points and fees, it's basically an either or. We're going to report either total loan costs or total points and fees. Now we'll report total loan costs if the loan is subject to ATR, TRID, and we'll report the total loan costs directly from line D of the closing disclosure. Now, total points and fees, we're going to report that field if the loan is subject to subject to ATR, but not to TRID, such as secured by a mobile home only with no land. Then we would report the total points and fees associated with the loan. If either of the above fields, the total is 0, we will report 0. You may not leave this field blank at all. If we move on to origination charges, line A of the closing disclosure, line A of the closing cost details page of the closing disclosure is where you're going to get that origination fee. If the amounts reported under any of these fields are changed on a revised CD, then you're obviously going to report the revised amount. Now, that's only if a CD is issued within the reporting calendar year. Report NA for non-originations, non-TRID loans, and for purchase loans where application was received prior to TRID implementation. If the total is 0, we report 0. Again, this is another field we cannot leave blank. Discount points. We report discount points from line A01 of the closing cost details page of the closing disclosure. Now, this line is only for points that are paid to reduce the interest rate. Again, if the amounts change on a revised CD that's issued during the same reporting period, then the LAR should be updated to reflect the revision. We report NA for non-originations, non-TRID loans, and for purchase loans where the application was received prior to TRID implementation. If this field is applicable, yet no discount points were paid, this is a field that you would leave blank. Lender credits. We're going to find our lender credits on the second row under line J at the bottom of the closing cost details page of the CD. Again, if these amounts change on a revised CD that's issued during the same reporting period, then the LAR should be updated to reflect the revision. Report NA for non-originations, non-TRID loans, and for purchase loans where the application was received after TRID. If the field is applicable and no lender credit was received, you would leave this field blank. Along to interest rate. Now, the interest rate is really taken from the LE for an approved not accepted or the CD on loans that are subject to TRID if it's a closed loan. That's what the regulation tells us. Otherwise, we'll report what's on the note or the rate that was approved for an approved not accepted application. You report NA for denials, withdrawn, or closed for incompleteness files. And if the rate was unknown when approved for an approved not accepted variable rate loan, you're going to use the fully indexed rate based on the index and margin at the time of approval. The next slide talks about prepayment penalty. Now, this must be reported for originations and applications that are subject to Reg Z, other than reverse mortgages and purchase loans. We report the prepayment penalty in months, and we would report not applicable if it was not subject to Reg Z or if it did not have a prepayment penalty. Now, we rely on Reg Z to determine if the loan or application includes a prepayment penalty. Our regulation always sends us to another regulation to look up the definition. So Reg Z would be where we're going to go there. Next field is DTI ratio. There's a lot that goes on with the DTI. If we have natural persons and the DTI was relied upon, we want to report the relied upon DTI ratio. We also want to report the ratio exactly that was relied upon and how it's documented in the file. If it has decimals, we report decimals. If the DTI ratio that was relied upon was rounded, we would report that rounded value. If we sold the loan to an investor, we must use the investor's calculation for that ratio. So for example, our 1008 or underwriting transmittal might have a DTI ratio that goes out 3 digits, let's say 42.521. However, we sold this loan to Fannie Mae, and the DU, which reflects their calculation, shows a DTI ratio of 42.52. In this scenario, we sold the loan, we need to use the investor's DTI, so we should report the 42.52 DTI ratio. And as we've mentioned with credit score and model, these ratios do not need to be the dispositive factor for the credit decision to be reported. Just as long as it's one of multiple factors considered, we're going to report that DTI. So just as an example of this that we're talking about, if an application was denied for credit history, but the DTI ratio is calculated and documented on our loan underwriting form, it would be very hard to substantiate that the DTI ratio wasn't at least one of those factors considered and relied upon for the credit decision. So we just need to keep that in mind. If we have it documented, it's calculated, we might as well report it because it'd be very hard to say we did not consider it at all. Moving on to we have a scenario. That's right. Before I move on to CLTV, we want to ask you guys a question. Now, the poll should pop up and you'll be able to answer these questions. Here's the scenario. Anywhere Credit Union approved a loan at 80% CLTV ratio based upon an estimated value of $500,000 for the property. This was documented on the loan approval form. When the appraisal was actually received by the credit union, the value was $550,000, which made the actual CLTV ratio of 73%. This loan was never represented to the loan committee and never reapproved with these new values. So which is the correct CLTV ratio that should be reported? Is it A, 73%, B, 80%? It's not applicable, or I have no idea. Why are you asking me so many questions? So if everybody could just submit their responses there, that would be wonderful. All right, it looks like 80%. We have some 73, and why are you asking me so many questions? So if we move on to the next slide, we'll talk about CLTV ratio, and we're going to learn that the actual answer is 80%. So that scenario is actually one of the most common errors we find with the CLTV ratio. We must report the ratio that's relied upon for the decision rather than the final actual CLTV ratio. One of the aspects of the big picture of HMDA is transparency of who was allowed what, and whether that what was allowed favors one group or the other. So it's much more important to know that someone was allowed or granted a loan with an 80% CLTV rather than what the actual CLTV was. And just as DTI ratio, we report the value relied upon and documented. If a ratio has decimals, we report decimals. If it's rounded, we report the rounded number. If we sold the loan to an investor, we report the investor's CLTV ratio calculation. And if the CLTV ratio was not the dispositive, not the dispositive factor for the credit decision, we would still report that ratio if it was one of multiple factors considered. Loan term. The loan term is pretty straightforward. We want to report the number of months in the loan term, not the amortization period. If it's not in whole months, we're just going to disregard the partial month, and we would report not applicable for a loan without a definite term, such as a reverse mortgage. Introductory rate period. Now, this is the months from closing until the first date the rate may change. For non-originations, we report the number based on the proposed terms. We would report not applicable for fixed rate loans. We would report not applicable for preferred rate loans, such as those where the interest rate may change if the borrower is no longer employed or maybe closes a deposit account, unless the terms of the note provide that the preferred rate will expire on a certain defined date. For purchase loans, we're going to count from the origination date, not the purchase date. And if the rate can change in less than 1 month, such as a loan tied to prime that changes daily, we're going to report 1. Non-amortizing features. So on these fields, it's 4 fields that you're answering questions to. We're going to report basically whether or not the loan includes a balloon payment, interest-only payment, negative amortization, or other terms that would not allow for the other than fully amortized payments. Do not report NA in any of these fields. They're all applicable. We only have to report code 1 if the transaction includes one of those non-amortizing features, and code 2 if it does not. Now the regulation, HMDA regulation, sends us back to Reg Z for the definition of these features. However, this not the applicability of these features. So if we have a business purpose loan that's reportable transaction, and the transaction includes a balloon payment, then we would report code 1. We move on to property value. Report property value used in the CLTV ratio calculation relied on in making the credit decision. Again, we're going to report NA for withdrawn or closed for incompleteness, even if the property value was obtained. We're going to report NA if a property value is not relied upon. Now, the value could come from an appraisal. It could come from a broker's price opinion. It could also be the purchase price. Again, whichever value was used in calculating that CLTV ratio that was relied upon and documented for the credit decision. One of the most common mistakes we see is sometimes our approvals will include a CLTV ratio that was a global ratio, and that global ratio was based upon several properties and their total indebtedness. So you would report the global property value that was used in calculating that CLTV ratio that was ultimately relied on for the credit decision. The next is manufactured home security property type. We only have 3 choices here. We choose code 1 if it's secured by a manufactured home and land, or code 2, manufactured home only, no land, and we report code 3 if it's not applicable. Now, it's not applicable if the dwelling is not a manufactured home, so the construction method was site-built, and the dwelling is a manufactured home community that is a multifamily dwelling. Manufactured home land property interest. So we have code 1, direct ownership. That's if the applicant owns the land. We have code 2, indirect ownership, such as a member of a cooperative. We have code 3, paid leasehold. That's when there is an actual written lease and it specifies rent payments. We have code 4, unpaid leasehold. So that would be when no written lease agreement is out there. So for an example, the manufactured home is going to be put on some family land, unless your family makes you actually sign a lease. Report not applicable, code 5, if the dwelling is not a manufactured home, the dwelling is a manufactured home community that is a multifamily dwelling, and a location for the manufactured home just has not been identified. Next, we have total units. We'll report the number of individual dwelling units related to the property securing or intended to secure the loan, which means for a loan secured by single-family home in a manufactured home community or a single condominium in a condominium complex, we report 1 unit. Now, if we have a loan that's secured by the entire manufactured home community, we are going to report the sites available for occupancy, regardless of whether they're actually occupied. I know Brad touched upon this a little earlier. So just as if we took an entire condo complex as collateral, we would report every single unit in that whole complex, regardless of whether the units were currently occupied or vacant. And we want to rely on the information that's readily available to us at the time the action's taken. The next slide talks about multifamily affordable units. Multifamily affordable units is the number of individual dwelling units that are income restricted pursuant to a federal, state, or local affordable housing program. This count is based on the unit, not the tenant, and should be able to be evidenced based on restrictive covenants in covering the property. Now, many a times we can just refer to our appraisal because our appraiser has noted how many units are involved in such income restricted programs. We report NA if the property is not a multifamily dwelling rather than 0, and we reserve 0 for reporting if the multifamily dwelling has no affordable units. The next 2 slides, we only have a few codes to report. For application channel, we're going to report code 1 when the applicant submitted the application directly to your institution. We would report 2 when the applicant did not submit the application directly to your institution. So for example, the application was submitted to a broker entity first, and that entity brokered the loan to your institution. Report code 3, not applicable for only purchased loans. Initially payable to, again, code 1 when the loan was initially payable to the reporter, so your institution is the creditor on the note. You report code 2 when the loan was not initially payable to the reporter. An example of this would be for those loans that your institution took the application, but brokered that application to another institution, and that other institution is the creditor on the note. For initially payable to, we're going to report code 3, not applicable for purchase loans and applications that were withdrawn, denied, or closed for incompleteness if the reporter had not yet determined whether the loan would initially be payable to the reporter. Next field, the MLO NMLSR identifier. We will report NA if the originator just does not have an identifier, meaning they are not registered in the nationwide mortgage licensing system and registry. If the originator has a number, we want to report the number. And that's regardless if the application was business purpose or commercial or business purpose or consumer purpose. Basically, if they have one, report it. And if we have more than one originator that was involved in the transaction, we're going to report the NMLSR identifier of the individual with the primary responsibility as of the action taken. The next slide is AUS and AUS results. We're going to report the name of the AUS used to evaluate the application and the results of that AUS. We're going to report AUS and the results information if used to evaluate, even if where the loan's being kept in the institution's portfolio. So basically, if an application was run through an AUS, if it's run through DU, we're going to report that AUS and result. And of course, we can report up to 5 AUSs and 5 results. We want to report if obtained multiple AUS results, but only one corresponded to the loan type obtained, we're going to report that one. If we obtained multiple AUSs, but only one corresponded to the investor that purchased the loan, we're going to report that one. If obtained multiple copies of the same AUS, we're going to report all AUS results up to 5. Report the AUS results code that correlates to the appropriate AUS used, and report NA for purchase loans when an AUS was not used or for non-natural persons. We want to be aware that there are specific AUS codes that correlate to each of the four main AUSs, DU, LP, Total Scorecard, and GUS. And we may report a specific code for other and then use the free-form text field to specify that other system we used. Moving right along, which is our last fields of the day. Those are our transaction indicators. These final three data fields are reverse mortgage, open-end lines of credit, and business purpose or commercial purpose. For each of those, we're going to report code 1 if the application is a reverse mortgage, open-end line of credit, or primarily for business or commercial purpose. Again, primarily for business or commercial purpose, we look at the funds used are more 50% towards business or commercial purpose. And of course, we would report code 2 if the loan does not match any three transaction indicators. Now, that is a lot of data to report and to report accurately. But before I turn things back over to Brad to finish up for us, I just wanted to remind everyone of two important tips. Number one, be sure all the data reported is clearly documented in your files. It should be easily found and void of conflicting information. And number two, be consistent with your reporting methodologies throughout the production channels with your institution. This is going to assist us in a clean submission and an easier exam. So Brad, I'm going to send things back to you.
All right, thanks, Sadie. Very well done. So I know we're over time, and that's my fault. So I'll be brief, and I'll wrap this up pretty quickly. So resubmission and submission. Hopefully, it's more submissions and fewer resubmissions. So first up here, you've got a couple extra days this year since March 1st is Saturday. Hopefully, you won't need them, but if you do, they're there. Then drop down to that third big bullet point. And there's a new requirement this year, and that you'll need to use a login.gov account. I believe all banks and credit unions probably have that set up by now to correspond with their regulator. But be sure you check into that and are good to go ahead of time, so that's not a last minute stumbling block for you. On resubmissions, this is something we've seen more of lately, and even civil money penalties or fines. The CMPs usually come into play if you have consecutive exams where resubmission is required and the examiners don't think that you've done an adequate job of addressing your weaknesses. We've got a chart from the exam procedures on the next slide to demonstrate how resubmissions are determined. So look down like the second row from the bottom here. Let's say your LAR has 600 entries. The initial sample will be 35 entries. If two errors are found in any one data field from that initial sample of 35, let's say it was in loan purpose, then they'll pull an additional 44 entries for a total of 79. If within that 79, any one data field has 4 or more errors, then you'll need to scrub your entire LAR for those data fields and resubmit. So when you look at this chart, what it tells me is that most of you probably want an internal goal of something less than a 5% error rate in any one data field, so that you can feel pretty confident you won't run up against resubmission. We often get asked about resubmission, so I thought this might just be a good thing to throw in at the end and maybe hopefully help you understand a little bit better as to how it works. And then this final slide just includes some helpful links that should be live on the handouts that we send out with the recording. And then as usual, we'll end today's session with one last word cloud to see what topics you'd like for us to cover in future webinars. We've had plenty of good response to these sessions so far, so plan to continue them next year on probably about a quarterly basis, just like we have been. Let us know what you'd like to see, more HMDA, CRA, BSA, fair lending, whatever it is, just type it in. I know that several of you have been with us for all 4 webinars this year, so we appreciate you hanging in there while we try to get a little better at it each time. If you want to view any of our previous webinars, head on over to our website at www.anderscpa.com. Then click on Industries, select Banking and Financial Institutions, and then scroll to the bottom of the page where you'll find Insights. And that's where you can check out all the webinars and blogs. All right, and now I would like to announce the winners of the Starbucks cards. If we call your name, please send me an email, and my email address will be on the next slide. That way we'll be sure to have a good email address for you where we can send the e-gift card. If we don't get that, we may have to send it to somebody else. So the winner for poll 1 was Wanda Carden. Congratulations, Wanda. The winner for poll 2 was Olga Lopez Torres. Congratulations, Olga. The winner for poll 3 was Randall Kiner. Congratulations, Randall. And we'll have the winner for this last word cloud shortly. While we're getting that picked, let's forward on to the next slide. So here's how you can get hold of me. And it's got my email. So if you're a winner, you can shoot me an email. For those of you who are less familiar with Anders, we have a dedicated financial institution practice, been doing this for a good 20 years, and covers all things compliance and BSA, outsourced loan review and internal audit, ACH, ALM, IT, financial statement audits, taxes, pretty much anything a CPA firm can do for a bank or a credit union, we got it done. So we're still waiting on the poll 4 winner. If nothing else, we'll just send an email out to you. Okay, Christopher Clavier, Clavier, Clavier. Congratulations to you. So that's the 4 winners for today. Also on this slide, if you're interested in discussing any of the services or just want to talk a little HMDA, scan the QR code on this slide and it will take you to a booking page where you can set up an appointment. And then we'll slip to Sadie's contact information. You can get hold of her, especially if you have any real tough questions. She likes a good challenge. Sorry, Sadie. She's really as good as it gets when it comes to loan compliance. She's a great resource, so feel free to be in touch with her. And then finally, for reals, thank you very much for spending some time with us today and even throughout 2024. Whatever holidays you celebrate in the coming weeks, we truly wish that it's enjoyable and full of peace and joy. We'll be back in 2025 and hope to see you then. Bye now.